Hi there, everyone, and welcome to this week's market update. Don't forget that any advice contained within this presentation is general only, so it isn't tailored to your particular circumstances. You need to decide for yourself whether it's appropriate to you. Okay, so coming straight into the XJO here, you can see that most of the selling throughout the day has reversed, looking like a very similar bar to what we saw in the S&P 500 on Friday before the US markets went into a long weekend. So yeah, look, the market did break lower today for a period of time, but pushed back up above, mainly led by the miners actually, with iron ore breaking higher. We saw the miners finish off a pretty strong session. So materials came in and really saved the day today. Probably not much to say. XJO is still kind of on an uptrend, medium, long term, short term on a bit of a downtrend. Did get a bit overheated up here, need to give some back, which is what we're seeing right now. The question is whether it comes all the way back to 72 before rebounding again or not. But technically, it seems that it could be drifting back down towards those levels. We're just really waiting out and looking for where this is going to stop at this stage. Most of the selling's on the back of, the selling really begun back when the RBA announced a few weeks back. Okay, lifting interest rates became out super hawkish, right? It wasn't the rate hike; it was the hawkish tone from Philip Lowe. So yeah, look, until that sort of mood switches a little bit on the interest rate side of things, we probably see a drift off here, especially through the growth sort of stocks, the banks at this point as well. But miners might, like I said before, buying in the miners might come in and save the day, right? So that's what we're looking for at the moment. Coming across the S&P 500, as I said before, they were closed last night for a long weekend. On the Friday, once again, we saw that breakdown, which made us think it could come back towards trend and that 200-day average. I still think that's on the table, right? I'll be curious to see how things trade tonight. The futures have drifted off a little bit, but nothing really to write home about at this point. So yeah, look, I think a sell-off into at least 4,000 is probably on the table here. But yeah, look, it's always hard to make these calls after a long weekend holiday. The thing that's got me worried is obviously the bond space. We've seen heavy selling in the bond market over the last few weeks. We've definitely seen a change in tune towards interest rates, where everyone thought interest rates had pretty much topped. There could be another 2 to 3 rate hikes this year now starting to be priced in. And that's what's got people on the sell side in the bond market. And that's what could continue to see people on the sell side on the equity market. So it's just going to be a matter of time, and we'll have to wait and see. So nothing's changed, right? Have rates topped? Okay, well, probably not, right? But I could say that the rate at which the rates are hiking has definitely slowed down. We saw 75-point rate hikes last year. We come down to 25-point rate hikes. So the way markets are pricing things at the moment, there's another 2 or 3, which says we're close to the top of the cycle. Now, what you've got to be looking out for here is any data related to inflation at this point. Okay, that's the critical thing, and employment really in the US as well. That's what the Fed's really looking at. Is if the employment's super strong, then that leaves the doors open to raise rates further. If we start seeing unemployment rise, that means that some damage is being done, and they may slow it down a touch. So at this point of time, good news is bad news for the equity market, right? We don't want to see things be too strong, because that's just going to leave the door open from the Fed to have to keep lifting and keep lifting rates to the point where we'll see a hard landing. We don't want that hard landing. We're trying to see a soft landing as a result here. So we're happy to see some bad economic data, but we don't want to see horrible economic data. It's such a balance, right? And I don't think that we're going to see the balance come out this year. So, we're not going to see it as straightforward as it looked in early January, right? So there's going to be periods of pullbacks. This is going to be more of a W-shaped recovery this year than that massive V shape we saw coming out of COVID. Okay, we're going to see this whipsaw behavior happen. But I do feel we found the lows for the growth stock space. So the NASDAQ probably has found its lows, but there's going to be some volatility in between. Okay, so this is the dynamic that you're going to be watching this year. What are bond markets doing? Are they selling? So are yields going up? If yields are shooting up, it means that people are repricing interest rates, okay? And that's what we've seen over the last few weeks. If bond yields are going up, it means selling in the bond market. It usually means you'll see selling in the equity market to follow. And that's exactly how this couple of weeks have played out. So watch those bond markets, guys. They're a key indicator for a big sell-off in the market. If it keeps shooting higher in an aggressive nature, if those yields shoot higher in aggressive nature, then you've got to watch out for your equity holdings. Okay. So for me, markets are at a bit of a pivot point again. Okay, we've seen a small sell-off. Will that small sell-off become a bigger sell-off? Well, that's kind of what we're looking at. The S&P's hovering around that key support level. It broke it on Friday, but came up to test it again. So things are unclear, right? XJO broke key support today, but came back to trade up on it. So the next few days, we're going to soon find out whether the selling is going to continue for a little while longer or not. I'm probably leaning towards that we will sell off a bit further here, okay, on the back of the bond yields coming back up. Bit of uncertainty out there, a lot of hawkish talk out there at the moment, and I think that's going to have a lot of people a bit scared on the sidelines. So then what we might find in a week or so time, that sentiment might shift back around a little bit and might just take a lower CPI reading or something to shift that mood again, and it probably will happen, right? Markets always find a reason to fall and rise. Okay, and this type, especially in this type of environment where volatility's come back off, we're back into a bit more of a normal market compared to what we saw last year. We saw that big bear market. This year, we're back into a little bit more normality again. Volatility is not above 20%. It's below 20% for the most part in the US, which says to me we're back into more of a sort of bullish sideways type of market again. So expecting 2, 3, 4 weeks up, 2, 3, 4 weeks down, or maybe down a bit quicker usually, right? Okay, so that's the view at the moment, guys. There's probably not much else to rattle off. Not much has really changed in the market this year, other than we know what the market's focusing on. It's interest rates, it's unemployment, it's anything inflationary, it's how the economy is going around the world. The last thing I'd mention would be obviously the emerging markets and China theme at the moment. Obviously, anything revolved around there. That's why we're seeing iron ore and our miners pop so strongly at the moment. Anything tied to that sort of space is seeing a bit more buying right now. So you want to be looking at investment opportunities around emerging markets, miners, China. Okay, that's probably where there's a bit of a theme. Obviously, there's opportunity in the US growth and Aussie growth spaces once we feel the interest rates have topped out. Okay, so that's where we're at. Not much else to say. So thanks for listening in. Take care and bye for now.